Good morning. I'm Guy Johnson. I'm alongside Lizzy Burden and Mark Cudmore this morning, our Markets Live executive editor. Should be a fun show. We're an hour away from the opening trade. So what do you need to know? European and US futures are higher. The threat of a US government shutdown appears to have been removed. Chinese stocks are surging ahead of a press conference Monday that's expected to deliver a big boost for the country's consumers. Putin puts Trump's Ukraine peace plan to the test as he signals he's in no rush to sign a ceasefire. And BMW's bad fourth quarter. The German car company's numbers miss expectations by a wide margin, Lizzie.
Well, happy Friday, everyone. Checking in on these markets, and Trumponomics yesterday did send the S&P into correction territory. It's been a swift drop of 10% from that peak. But today we see optimism on both sides of the Atlantic because of these hopes that the US can avoid that government shutdown. You've also got the CSI 300 reaching a new record past that 4,000 mark. Can it end the weekend past that? On the hopes of more consumer policy support. Gold had touched a fresh record, but the relief sending it back down now. The countdown to the opening trade starts right now.
Friday morning, good morning. It's the 14th. Let's talk about the data that is dropping onto the screen right now. UK GDP, this is the monthly number, not the quarterly number, but nevertheless important. The January number comes through at negative 0.1. Now, the prior was 0.4. These are small margins we're talking about here, but we have dipped into negative territory. I think that's the takeaway here in terms of this data. The expectation was that we would stay in positive territory. The British pound takes a little bit of a hit on the back of these numbers. Let's talk about what's happening with the wider markets. We do seem to have something of a risk-on sentiment percolating through markets this morning after what has been an incredibly tough week for risk assets. Mark, good morning. You're executive editor for markets. What's going on?
Well, we're getting a bit of a relief rally because of this.
Yep.
Supposedly, we're going to avert the shutdown in the US.
Yep.
As I kind of said yesterday, I think there's a little bit the narrative to fit the price action.
Always.
I think we are ready for a bit of a relief rally. We've had a really, really rapid drawdown. I think, you know, the work from our own Valerie Teitel has kind of pointed out that of 48 corrections in the last 75 years, this is the fifth fastest correction of 10% from a record high. So, you know, this has been a really, really rapid drawdown, and therefore we are ripe for a little bit of a relief rally. What's actually interesting to me is it's really quite tepid still. I'm actually a little bit worried given how poor the price action is. I mean, as I said, I don't think this is a particularly big news, particularly good news, but we're not getting much relief rally, and therefore I think we have one more washout ahead of us, especially with big catalysts next week.
You're going into a weekend as well, Lizzie. How much risk do you want to carry into a weekend? Trump doesn't stop at the weekend. Things don't stop at the weekend these days. Mark's talking about kind of fairly tepid reactions to some of the news that we have seen thus far. You get to Friday afternoon. Do you want to carry risk? Do you want to take it into Monday? Is that what you want to do?
Well, look, it's interesting. We heard from the former US Treasury Secretary Steve Mnuchin saying that, as you kind of say, this is what you can expect. You had markets so priced into the Trump presidency that if you get a 10% correction, it does kind of make sense. It doesn't mean that there's necessarily going to be a recession. And it was interesting to hear Wei Li at BlackRock kind of making that same point, that just because you have a step back from US exceptionalism, it doesn't necessarily mean that you're going to have a US recession.
Yeah, but I think that the big catalyst, the thing that's going to really change the narrative on whether that recession is coming, is how fragile we were kind of going into this recent turmoil in stock markets, because it's the wealth effect that's impacting things now, and that's why it's retail sales on Monday that's so important. So going to your point, Guy, do you want risk into the weekend? It's not just risk into any weekend, it's risk into a weekend where we have retail sales on Monday and then the FOMC.
Now, let me just take a moment to bring you some breaking news. A redhead crossing the terminal. This from the ECB, that it's authorised UniCredit to boost its Commerzbank stake to up to 29.9%. So some really interesting news, Guy, when it comes to the European banking consolidation story here in terms of moving this along.
Yeah, this does feel like it's a cross-border consolidation move by the ECB, which I think is interesting given the political resistance. There's a story that's just kind of catching my eye as well, which I think might entertain Mark. China is mulling a mandated 50% pay cut for underperforming fund managers.
Doesn't seem sensible to me, actually. I think it makes sense. I wonder over what time span they're judging that. I think people feel it's quite harsh if it's only judged over a one-year time span. But if you're underperforming over several years, absolutely that makes sense, yeah.
Could that be applied elsewhere?
I think it should be. Look, I'm all in favour of that. Those who continuously outperform should get paid extremely well. But, you shouldn't be too generously lenient in those who don't keep on outperforming.
OK, well, so let's just go right back to yesterday, because, of course, we have the relief today on the expectation that maybe there won't be a US government shutdown. But as we've been talking about, the reason that you had stocks hit so much was partly because of this whopping great tariff threat from Donald Trump yesterday, 200% on EU alcohol. And that, of course, in retaliation for the EU's retaliation against these new US steel and aluminium duties. So that knocked the drink stocks yesterday. We heard from Christine Lagarde, the ECB president, in an interview with the BBC, notably before this 200% threat, but saying, look, a real trade war is going to have severe consequences, and it's no wonder that Brussels is retaliating. That's exactly what it should do.
Escalation.
I mean, I think Europe was always going to be probably one of the most vulnerable to Trump's trade war. I'm in the camp that he does want to generate revenues, and therefore some tariffs will have to be applied to some major trade partner. That really only limits it to China, EU, Canada and Mexico. You can't get enough tariffs out of Vietnam, for example, and therefore it's which country can offer something back in return. And the EU will find it harder to offer back, and I think politically they're less inclined to. So I think EU will be the victim.
Is that in the price, though? Yet. Euro's been surging. German market's been going to the moon.
No, it's not.
It doesn't feel like that's in the price.
I think lots of the tariffs aren't in the price as much, because I think there's still a big divide out there. There's a large chunk of the market population who think that ultimately, yes, this is longer, more vicious than last time, but it's ultimately negotiation and bluster, and they won't be sustained.
Do you think what's in the price for Ukraine? What's in the price for a peace deal? Because, again, that's another risk story, isn't it?
I don't think much. I think the problem is all these European narratives have all been conflated, because we've had the massive shift on defence spending, the whole changing around the fiscal approach from Germany and generally in the EU. That's tied in with potential for peace. And then, of course, we've had this whole end of the US exceptionalism, looking for alternative. I think the one that really lasts is the fiscal spending. That paradigm shift is the sustainable one. OK, let's just talk a little bit about what is happening in Ukraine. So the latest appears to be that we've had a peace deal that has been agreed by the Ukrainians. Zelensky's agreed to Trump's terms. Now it's basically over to Putin. Putin hasn't ruled out this peace deal. Of course he wouldn't. But what he is basically saying is that I'm going to ascribe a series of conditions to the deal to get done, which become or make it more onerous and difficult to get done. So the real question is, I think at this point, is how does Trump respond if Putin does not accept this peace deal? There will be significant pressure in Congress to go quite hard on him. Will he do that? I think it will be a real source of tension in Washington if the deal doesn't get done. Do you think people really expected that Putin would accept? So are we not just kind of following the path that everyone's accepted?
Doesn't the White House accept that was the expectation. We're going to get this done. It's going to get done fast. Yeah. We've put a lot of pressure on Zelensky. He's signed up to it. Putin doesn't sign up to it. What does Trump do? I'm not saying that the expectation wasn't that he wasn't going to do that, but what does he do in that scenario? And that's the bit that I don't know yet. That's the unknown to me in this story. The known, as you say, is that it was always going to be tough to get Putin to sign on.
Look, surely part of the reason why the market isn't so excited about this yet is because they are looking at the realism of this. And yes, there's warm words from Trump about Putin, but in the background, you've still got the US tightening the screws when it comes to sanctions on Russia. And we don't know how much that's actually going to impact the oil trade, but this is something that's the real thing that's happening in the background.
I'm just going to fold in Germany here very briefly, because you were talking about the fiscal story. We still don't know Tuesday whether or not this Merz vote is going to go through and whether or not he's going to be able to achieve what he wants to achieve on spending with this old Bundestag. At the moment, the Greens are basically saying, you know what, we don't know yet whether we've got enough. We're not signed up to the deal. You've also got in the background German coalition talks that are taking place as well. And there's a whole range of really interesting things on that list in terms of minimum wage, what's happening with benefits. Conscription is on the list in terms of what's being discussed as part of that deal as well. There's all kinds of things at the moment that I'm not sure the market's quite kind of latched onto yet.
Yeah, and if it's a difficult day on Tuesday, what happens to the DAX? Because if you look at it over the past month, actually it's back to where it was a month ago.
We'll move on. We'll talk about another German story in just a moment. We need to focus on the guests that are coming up. Oliver Zipser, the BMW CEO, is going to be joining us, or has spoken to Ollie Crook, and we're going to be hearing from him in a few minutes' time. We're also going to get the Skoda CEO on the programme a little bit later as well. Beata Manthi, Citi's head of European equity strategy, is going to be joining us. And Monika Schnitzer, chair of the German Council of Economic Experts, is going to be joining us a little bit later on. Something of a German theme running through the show today.
So that's who we've got coming up on the programme. In terms of the data out today, at 2 p.m. London time, we get the University of Michigan consumer sentiment data. And then this evening, sovereign ratings updates for France, Greece and Portugal. And later today, that US spending deal deadline, of course, whether they can avoid the shutdown. But I'm interested in this consumer sentiment data. Mark, I wonder whether, even if it's good, it'll necessarily translate into better consumer spending.
Not necessarily, but obviously people are going to take it as a real kind of lead indicator for retail sales on Monday. The high-frequency data are showing worrying signs of a bit of a slowdown to the data. People are very nervous about it. Credit card spending, etc. Some of that lead stuff is saying a bit negative. I do think, I have to say this, on the University of Michigan, inflation expectations, absolutely useless. No one should pay any attention to it. I know we'll get very excited, especially if it's a high reading. Ignore that. The sentiment one is the more important one for Monday.
But the market reacts to it.
I know. But they shouldn't.
There's so much politics in there as well. You can judge. Julie Hsu does the data. It's fascinating to talk to her about this. If you divide it down political lines, you get such different readings in terms of expectations.
But we react to it with a bias. I think, that the point is that there's a market that's worried about the inflation story. So if we get a high inflation expectation story, people are absolutely going to react to that. It's going to feed into the market. If it's low, people will dismiss it, but they should be dismissing it either way.
Yeah, current expectations 1 year out, 4.3. That's the number. Be interesting to know what the eggs expectation is. There's certainly seen some inflation there. What else do you need to know this Friday morning? Lots going on. Kering has picked Demna Gvasalia, the designer who fueled sales growth at Balenciaga while courting controversy as the new artistic director for Gucci. Under his creative leadership, Demna, as he is known, drove the brand's popularity with sneakers such as the Triple S. Definitely got a pair of those. Recognisable, of course, by their exaggerated size. Demna succeeds Sabatano Desano, who is leaving only after 2 years. Fashion, my strong suit. We'll talk to Lizzie about this in just a moment. Portugal, Mark's really on this one as well. Portugal's going to hold an early election. It's going to be on May the 18th. This after the government was ousted in a confidence vote. The collapse may delay some key decisions, including infrastructure investment and defence spending. TAP could also be affected by this as well. Country's third snap election in just 3 years. The Prime Minister, Luis Montenegro, is expected to seek re-election. And Chinese shares hit their highest level this year on an announcement that officials are set to hold a press conference Monday to discuss measures to boost consumption. The market moves reflects renewed optimism over policy stimulus. This after the government set that ambitious economic growth target, you could argue, of around 5% for this year. There's also all kinds of rumours swirling about rate cuts and other things going on as well. Mark, they are struggling to get the consumer going, but this is the core of what the Chinese authorities need to deliver. How big do they need to go? Because at the moment we're seeing sort of incremental moves. You can get credit to buy a washing machine. Is it going to go further than that? Much further than that? No, I don't think we're going to get some big bang kind of approach here. I think it's going to continue being incremental. I think what's important is they are kind of changing that kind of aircraft carrier of sentiment around China very, very slowly. And I think it's positive. I think just it'll probably again disappoint on Monday because people get so excited by these press conferences. It'll be short-term disappointment. But I think it's just a continuation of what we've seen since last September. Remember, the key message from last September is they realised markets are important and they weren't going to let markets be lower a year from there. And they're not going to let them be lower a year after that. They're not necessarily going to boost them, supercharge them, but they're going to make sure they keep on drifting a little bit higher net. I just want to fold in as well that Honhai had numbers out this morning, which were hit pretty hard by the iPhone's underperformance in China, which I think is also an interesting tale around all of this. Lizzie, Triple S's Balenciaga shoes? You know a bit about that, don't you?
You were teasing me about my ugly trainers, Guy, and that's all you need to know. Ugly is out. And we're back to beautiful, elegant. That's the story.
So the green trainers are going, yeah?
Yeah, OK. my designer Crocs. Let's get back to what else is coming up. It's BMW's bad fourth quarter. The German car company's numbers missing expectations by a wide margin, and we're going to bring you an interview with the company's CEO later this hour. Plus, the European Commission's Foreign Affairs chief says that the EU will defend its interests if the trade war with America continues to escalate. We'll bring you more from that interview with Kaya Kallas later in the show. But up next, we're going to be joined by Delphine Arnaud, multi-asset portfolio manager at Edmond de Rothschild. And if you've got any questions of your own for our guests, please do send them in to us on IB plus BBTV Go. Stay with us. This is Bloomberg.
17 minutes past the hour. Japan's largest union has tallied up all the wage deals that have been done by its members and member groups and put them out there this morning. The yen's not moving on the back of it, but I think it's interesting. Rengo is basically saying that employers have pledged a 5.46 wage hike this year versus 5.28 last year. Small firms are winning a pretty decent 60 basis point hike as well, 70 basis point hike. Basically, what we are seeing here, Mark, is a continuation of a trend. Wages are rising in Japan. The BOJ is going to continue to react to that. It sounds hawkish at the moment. The dollar is up this morning, but the yen is a really interesting trade right now on the back of how hawkish maybe the BOJ becomes.
Yeah, it's an incremental step in the story. But what's interesting is I got asked the other night whether Japan is an idiosyncratic story to what is going on. Like, is there a genuine, sustainable Japan is escaping 30 years deflation that you can trade that narrative, not in isolation from the rest of the world, but in, is genuinely an idiosyncratic in parallel and tandem to what you're trading elsewhere. And I think there's still debate about that. I think, like, can the turmoil immediately reset trying to put it back into that deflation, or has it got escape velocity? This helps the narrative that it's got escape velocity.
OK, well, let's talk about the narrative stateside, because yesterday, of course, we did see stocks in correction territory. But really, it's the speed of that correction that's interesting. And we can go to Valerie Teitel with more on that. Val.
Yeah, Lizzie, that's right. Don't be fooled by the overnight optimism. It has been quite a tumultuous week for the U.S. equity market, setting us up to be the worst week of 2025. And that goes on to last week, which was already the worst of the year. Back-to-back losses of over 3% for the U.S. equity market is something we haven't seen week on week in over 2 years' time. The speed of this correction really catching many by surprise. And what could possibly lead this correction to go into a bear market territory? It has to be accompanied by an economic slowdown. If you look at the last 48 corrections that we've seen in the S&P 500 since World War II, nearly 25% of them have translated into a bear market, but have been accompanied by some slowdown in economic growth. And to that, guys, we have our eye on credit spreads, some widening in credit spreads that we've seen this week. It has roiled the credit market, but I have to say that credit spreads are only widening from very significantly tight levels. So is this the first, maybe hint that we're headed toward an economic slowdown, or is this just a normalization move in the corporate bond market?
Valerie, we're going to watch this one with interest. It's been quite the week, hasn't it? And yes, we're getting a bit of a bounce this morning, and maybe that bounce is due to what's happening in Washington, etc., or it could just be a little bit of exhaustion coming through. Delphine Arnault, multi-asset portfolio manager at Edmond de Rothschild, joining us now to discuss. Delphine, it's been an epic week, risk off, particularly for the United States. That's where the focus has been. How are you feeling this Friday? Is it time to get risk on? Is it time to dip your toe back into these markets?
Hi, thank you for having me on stage. Currently, what I feel is that it's very tempting to look for entry points in the markets, because at the beginning of the year, we were quite cautious on equity exposure, given high valuations, especially on NASDAQ and US stocks. Now, valuation seems more affordable, so it's tempting to look for entry point. The point is that we are on a crossroad currently. It's either we are triggering a Trumpcession, meaning according to Trump, if there's no pain, there's no gain, and it would be okay with a small slowdown for the beginning of the year, blaming Biden administration, and that's the point. Do we trigger a slowdown, not a recession? I don't believe about that, but a slowdown at the beginning of the year.
So you don't see a recession coming from this?
No, for now we don't see the recession coming from that. To trigger a recession, usually it comes from high inventories or margin deteriorating, pushing companies to cut costs, which triggers higher unemployment, things like that. We're not really in this kind of environments. Leverage, except from public sector, are quite healthy, and so we don't see this coming into a recession, but we should acknowledge that growth, U.S. growth was quite resilient last year, but not robust. The foundations of U.S. growth was consumption, private and public. Public is going to end, but private consumption is focusing on the more wealthier, the 10% wealthier of Americans are accounting for half of US consumption. And these kind of people are not very tariff sensitive, price sensitive, but they are very sensitive to S&P, wealth effects, real estate wealth, and currently the drawdown of S&P really questions this wealth effect. It works in the two sides.
Delphine, good morning. You know, when Guy asked you that question about this turmoil in markets this week, you immediately pivoted to US stock markets, where a lot of the attention's been. But I'm curious, are you kind of still in the Tina mindset? There's no alternative to US tech stocks. You're talking about you're looking for chances to re-entry, and it's immediately assumed you're talking about US stocks. So am I right to interpret that you kind of don't give much weight to the idea of this as the end of US exceptionalism, and that the really exciting opportunities in the next year or two are perhaps outside the US?
Yes, at the beginning of the year, we were talking about broadening, and broadening is two ways. It's first broadening outside of tech stocks, Magnificent Seven, within U.S. equity market because the growth was still resilient, and also broadening outside of U.S. market, being still confident on Europe, China tech. We love that thematics. So currently, we're still okay with the broadening outside of U.S. thematic. It's just that the tariff haven't been impacted yet in European growth data, and neither on EPS growth data, because we don't have any data about tariffs. It's still in a negotiation process. So confident but cautious on European equities.
Well, yeah, as we wait for certainty on tariffs, Delphine, good morning, Lizzy here. Can euro-dollar actually climb much further until we get it?
On the dollar, we used to love dollar for the last 3 years because it was a perfect hedge against inflations. Currently, inflation is fading, and tariffs, it would be a transitory inflation, especially if tariffs goes fast in a one-time move. And so we're not very concerned about inflation currently. It's more about growth. And in a growth environment, yes, we have to reduce our allocation to dollar and find a better edge in the portfolios. The best edge we found is to reduce our equity exposure at the beginning of February, after being neutral in January. So we are negative on equities. We stuck like that. We like equity protections. Volatility is growing. And in the meantime, duration was not very helpful, and dollar neither. We increased the exposure to yen, which worked quite well against dollar, and we are looking for better entry points to buy euros.
Okay, Delphine Arnault, multi-asset portfolio manager at Edmond de Rothschild. We thank you. Good to have you, as always. Well, actually, speaking of currencies, interesting that it's just now that we actually see the yen moving weaker 0.8%. 148 is where we are against the dollar after you spoke about the news earlier on unions. So finally, we see that reaction in the currency market. But coming up on the programme, we are going to hear from BMW's CEO after the German car maker's earnings missed this morning. That conversation is coming up next. This is Bloomberg. Well, we have already had out this morning BMW with disappointing results this morning. Bloomberg's Oliver Crook's been speaking to the CEO, Oliver Zips, about that report, tariffs and more. Take a listen.
Overall, we take a conservative view. We take about $1 billion, which is about 1% in EBIT. But on the other hand, we advocate free trade at the same time, and we don't think that all these tariffs will last for very long. Some of them might last a little bit longer, but we accounted for that with 1 billion euros in our guidance. So from that point of view, we're quite safe. But at the same time, we of course fight for free trade, because if you overdo it with tariffs, it sends a negative spiral to all market participants. So there is no winners in that game. And let me add one final word. We have a plant in Spartanburg, which is the biggest plant at BMW. Of course, that is kind of a natural protection, because more than 50% of the products we sell in the United States are produced in the United States, and therefore they're covered from any tax changes.
And I saw that also by the export value shipped from your South Carolina plant, it is that you're actually the biggest exporter of U.S. cars in the world. Is that a point that you have made to the Trump administration?
Oh, yes. Oh, yes. I spent 2 days in the United States in Spartanburg, and we had very close cooperation with the South Californian government. And, you know, we create 120,000 jobs in the United States, direct and indirectly. Almost 12,000 people alone in South Carolina in our plant. So we're at our heart. This is our second home. And in the last 10 years, we had more than 100 billion in exports since 2014. So we are a not to be ignored market participant over there. And we have strong support. Yeah, as we speak, one final word. As we speak, we invest almost $2 billion in the United States, and that is, of course, politically a big asset for us.
And then in terms of your sort of operations in Mexico, you say that you're, is it correct that you're absorbing for now the cost of the tariffs? Is that what that 1 billion euros you've sort of put forward to? And also, do you consider the USMCA agreement to be safe? And and if it is, are you going to have to sort of change how you build the cars in Mexico so that they're USMCA compliant? Is that something that you're planning to do?
Yeah, look, we took care of these effects in our guidance already, and USMCA. This is again a very volatile thing. We have to see what is happening in the last today. But again, we took a conservative stance and put it into our guidance.
And in terms of the Chinese market, because this is another sort of point, it sounds like it deteriorated again in the back half of the year. Do you expect sales to decline further this year?
Actually, no. We went down with about a little bit over 100,000 units. You know, what is happening in China is quite a natural thing. The market share of Chinese manufacturers has increased in the last 5 years significantly. And that was something which we expected. This is not a surprise so much. It is still, to this day, the largest car market in the world. We sold last year more than 100,000 electric-only cars. And from a market share point of view, still, the market share in China is higher than in the rest of the world. And we are still the leading premium segment participant. So we, of course, we know this is a tough market condition. We are aware of that, especially on the pricing side. But on the other end, we see we're going to stabilize there over the course of this year.
The BMW CEO speaking to Bloomberg's Oliver Crook, who joins us now to discuss all of this. Ollie, just clear things up for me. It sounds like what he's saying is that we are guiding conservative. We are folding in expectations around what tariffs could do, but we don't think in reality, actually, that risk will emerge and won't be there for that long. So is he basically saying we've guided conservative, but actually we probably think that's the worst case scenario?
It sounds like it, Guy. I mean, listen, what they've put forward is basically €1 billion. So this is the first time we've got that figure from them in terms of what the cost of the tariffs are. Now, we should be very clear that this is not his expectation for the tariffs that would be coming in April. That's the big one, right, that Trump keeps alluding to. And that is what would basically affect what is coming from Europe and going back and forth there. This is specifically to do with the cars that they produce in Mexico. They make the 3 Series in Mexico. And the problem with their operations within Mexico is that they're actually not USMCA compliant because not 75% of the value of the car is produced in Mexico. So they needed to basically absorb that €1 billion hit. Again, I think it's very hard as a car maker right now to give any sort of guidance, but for the time being, they've basically put a dollar figure on that, and it's €1 billion. That being said, it's still a very sort of challenging environment for them in Europe and in China as well. I mean, we should just get through a couple of the numbers. I mean, their margin last year was at 6.3%. That is very low by sort of luxury car standards. By BMW standards, it was almost 10% in 2023, and they've guided it this year to be about 5 to 7%. And again, this has also to do with a huge amount of money that they spent last year into their new series of cars, the Neue Klasse. We talked to him about that too. They're going to start production of those this year, but they won't be delivered until the beginning half of next year. So this is all sort of kind of the same thing that we're hearing about a number of sort of car makers here, that really 24 was a transition year. 25 is really the execution, and hopefully recovery in 26.
And Ollie, speaking of worst-case scenarios, the other facet of uncertainty, of course, facing BMW is German domestic politics. We've got that big vote coming next week. I know you've been following all the twists and turns as we get towards it. Friedrich Merz really getting criticised from every angle at this point. Do you think that actually he's going to get the supermajority that he needs? Is it looking that way?
So listen, this is still a sort of open question here. I think that ultimately, because right now where it's stuck is there's a debate about whether or not the Greens are going to get on board. I think ultimately, potentially they will get on board, but it will probably change what they're planning to do. I won't get into all the sort of nitty-gritty details about what the Greens want to amend, but basically what Friedrich Merz wanted to put forward was something that could amount to basically €1 trillion worth of spending, all debt financed, and that is something that the Greens are sort of theoretically on board on. That's what they wanted to do, debt brake reform last time around, but now they're sort of coming in and saying, you're just basically going to use this to fulfill all your election promises, and it's not really going to go to serve our interests. So they want to make some changes to it. Well, the question is that, Lizzie, if they do not get this over the line for Friedrich Merz has shown himself to be a real gambler here in the German political system. He did that vote where he voted alongside the AfD, again, breaking with all kinds of precedent, really upsetting a number of people. If he is not able to pull this off, I think there are some real questions about whether or not he's going to be the next sort of Chancellor of Germany. Again, he is sort of fighting for his political life and everybody in this sort of political spectrum to try to get this through. But we're really going to find out at the beginning of next week really how ugly this process is going to be. And again, we should say, as all of this is going on, it's very strange and kind of without precedent for the Chancellor coming in to basically use the old mandate to do constitutional reform, and that is a fact that the AfD has continuously made, and again is saying that basically this is an undemocratic process. Is sort of something that sort of cuts through not just to the AfD supporters. That is something that a number of people in Germany really are raising their eyebrows about his sort of approach on dealing with the debt brake.
Fighting for his political life already. Bloomberg's Oliver Crook, we thank you for that analysis as we look ahead to that vote next week. Now let's go to another top interview. Back to the tariff story. The European Commission's High Representative for Foreign Affairs and Security Policy, Kaja Kallas, has said that the ongoing trade war with the US ultimately harms the consumer. She told Bloomberg that Beijing may be the main beneficiary.
We are not interested in trade wars. There are no winners in trade wars. Who is laughing on the side or looking at the side is China, who is really benefiting from, U.S. having a trade war with Europe. But it is also clear that if these tariffs are put on us, then we are also defending our interests. But like I say, in the end, eventually the consumers get to pay higher prices, and that is not in the interest of anybody. So we really try to avoid these things, but of course we see this news coming all the time. I think right now it's important to keep cool heads because we see the statements, and then what really matters is the actual steps, the legal acts that are done, and then we are also ready to react.
A stupid question or a basic one, but are you confident you know what the U.S. wants when it comes to this trade war? As you watch all of these salvos and escalations, do you know what you could do or might do to appease the President of the United States and end the war that started a few weeks ago?
Well, of course, you have to ask the President of the United States what is their goal regarding this. But what they have been or what they have been saying out is that there is a trade deficit between our countries. It is of course not that big, and we can address this in a different way. But it is how it is. Like I say, we keep a cool head, and of course we are ready to act and defend our interests when we need to.
Bloomberg's David Gura speaking to European Commission Vice President for Foreign Affairs and Security Policy, Kaja Kallas. So Trump has pushed around Canada, and when Canada responds, he gets aggressive. And we see Canada in some ways backing down. I wonder whether Europe's going to back down. I wonder whether the impacts also of an escalating trade war with Europe, a much bigger economy, a huge economic footprint, will be something that Trump takes on with a little bit more care, maybe. How far will both sides go in terms of escalation at this point? I wonder. How much further can they go?
I think it'll go quite a bit further. So the big picture I'm looking at in this trade wars thing, first of all, I think he is committed because he wants revenues, as I said earlier. So therefore, what forced him to back down? And I guess if he keeps on getting wins, he's not going to back down. Now, how does he get wins? It's that he picks opponents off in the trade war one by one, and people capitulate, agree a deal, give him a win, he kind of moves on.
But Europe's so much bigger.
Well, it is true, but if Europe is standing alone, it's less problematic for the US if he gets a bunch of other wins, and eventually he might kind of try them out. Remember, US is still more powerful. What is most interesting is if other nations start coordinating the response. So there's two things to watch.
Yep.
One is Canada said in their response this week that their response was in coordination with the EU, like in communication with the EU. So that was really important, first point of coordination. And second of all, if Carney wins this election on playing the hard man and governments around the world see, like, oh, wait a sec, I stand up to the US and I get re-elected, the nationalist vote is what gets me re-elected, suddenly that's going to inspire other countries. So if Carney wins the election, that's really a big point.
Yeah, but what does it do to his economy afterwards?
I think that's not the point, because I think the US will be forced to back down. Because the damage to the US is much bigger than I think the US has realised. Sure, Canada gets really hurt in the short term, but they can't just give away a massive concession and be long-term damaged. So what it is, it's saying to governments, no, you'll be backed politically if you take the pain short term.
OK. We'll have to see how they respond. Howard Lutnick, of course, the US Commerce Secretary, saying, I wish everybody would be like the UK and Mexico and not fight back. Wonder whether the EU will listen to that. But coming up on the programme, Gucci gets a new artistic director who's raising some eyebrows in the fashion world. But could this appointment be eclipsed by parent company Kering's overall performance? We'll get to that next. This is Bloomberg. Fourteen minutes away from the opening trade, and we've got futures pointing higher on both sides of the Atlantic this morning. But I want to zoom in on Spain now, because it is having its moment in the sun, as Kriti Gupta would tell us. It's been the fastest growing economy in the European Union recently, and investors have been taking notice. But with economic policy and politics across the continent rapidly shifting, how long can the country sustain its relative outperformance? Well, our opening trade anchor, Kriti Gupta, is at the Bank of Spain in Madrid this morning for us. Kriti, tell us, how sustainable is this positive run for Spain?
I mean, Lizzie, we've been talking about this for ages here, where so many people are looking at German debt or French debt or even Italian debt and saying, no, thank you, let's go to Spain instead. And that has created this massive run, to your point, in the Spanish economy. A lot of that driven by tourism, a lot of that also driven by this increase in exports to the rest of the world of non-financial services. So things that really have been in flux since post-GFC. The question for the Bank of Spain and the broader ECB, though, as you point out, is how long that should last. A couple of days ago, the Bank of Spain released their monetary projections for the year and the next 5 years, to be more specific, and basically said Spain is on the right growth trajectory. But the key question is the uncertainty in the geoeconomics of the world. And a lot of that comes down to that outperformance, because now, since that monetary projection was initially laid out, you've seen this massive move in yields when it comes to the German yield, and even some of the French stability starting to seep into the economic sphere there. So the outperformance that they're talking about, that they've kind of hung their hats on, hasn't actually have a ton of legs in terms of the future performance. That's where the concern lies. If you look at those projections, the word uncertainty comes up quite a bit. The word tariffs come up quite a bit. And the question ultimately becomes, not just for the Bank of Spain, but for the ECB, how much of that uncertainty is inflationary, or do we skip that phase and go straight to the deflationary risks in the markets?
3.6% yesterday. French OAT sitting there. I think that's a 14-year high. The French papers are talking about that this morning, I can tell you. Let's talk about how the ECB gets ready, develops a framework for how it's going to react when tariffs start to become a meaningful part of the debate. We've already had the United States talking about a 200% tariff on European alcohol sales. What does the ECB do with that? How does that further complicate the picture, and how ready is the ECB to deal with that?
Well, they are absolutely ready, and that's where the question around the April rate cut really matters here, because right now the markets are pricing in a rate cut in April. But the risk here is that perhaps you hit a pause instead and completely change the game of this kind of ECB eye on the neutral rate. So the rates mechanism is one way that they can look at that. The other, of course, is going to be where a lot of this shows up in terms of other things, other kind of regulation that they can remove. And this is where the ECB can actually perhaps create a little bit of ease for a lot of banks, not just in terms of the defense sector, but in terms of the banking sector as well. And these kind of innovations, these kind of moves can then help a lot of the European companies and countries target things like that 200% issue on tariffs. Now, ECB's Christine Lagarde earlier this week had an interview with the BBC saying she is concerned about the trade war situation. But right now, the ECB is positioning us the same way that Jay Powell did in 2019 during the first Trump administration. This idea that you have to look at it as an insurance rate cut and not really prepare for necessarily the inflationary uptick, but start to brace yourself for a real slowdown in growth. Now, how these countermeasures actually help or kind of hurt or hinder that case, that remains the question. That's really the conversation I'm going to be having with the governor of the Bank of Spain, who sits on the governing council of the ECB, about how he really should be thinking about the tariffs. Does the first Trump administration provide an accurate roadmap to interest rates in this part of the world?
What time's the conversation, Critty? When are we looking forward to this?
The conversation is happening today. We're going to have a big conversation, but of course it's going to hit Bloomberg TV and digital on Monday.
Yep. Looking forward to it. Critty Gupta in Spain. Natural habitat for Critty Gupta. OK, we'll come back to that a little bit later. Mark, I want to come back to you and talk a little bit about these markets and figure out what is going on. So here we are, OK, Friday morning. Stocks are higher. Is that reaction to the fact that we're not going to have a shutdown? Is it a reaction to something else? Is it just a positioning story? Is it, how should I be thinking about the bounce that we're seeing this morning, albeit it's in context a relatively small one?
So I think there's two time spans to look at this. So I think there's a massive fundamental shift around US stocks. I think that's the end of the US market's exceptionalism. And I think that's what we've kind of been trading, part of that recently. And we're probably due to pause on that, because that's a multi-year shift, and it doesn't need to go in a straight line.
It's been fast.
It's been very fast. And part of the reason very fast has been a short-term negativity on top of that that's been really intensified. We've kind of hit a negative spiral of buying the dip suddenly wasn't working. This correction has worked really rapidly. And I think what's happened is we've kind of got overstretched maybe on both those themes. Now, actually, to me, the short-term ones I'm a little bit more nervous about. The price action to me is still pretty poor. And I think, given we've got retail sales on Monday, we've got University of Michigan sentiment today, I wonder whether we have one more washout into next week. Maybe if retail sales is weak, that's what encourages FOMC to be a bit more dovish next week, and that's maybe what turns the story around. What's actually interesting is March 15th is normally the big turn in seasonals, and that actually works with some of the kind of the tax selling effect in the US. And I don't normally put too much weight in that, but if you go back decades, from March 15th is normally a much better period for US stock seasonals, which would tie in with next week starting to get a bit of a relief rally for a couple of weeks. However, ultimately, I think that bounce will be sold into.
Mark, can I come back to the question I was asking Delphine about euro-dollar and really how much further it has to climb? Because surely you have to factor in the peace in Ukraine and all these talks happening between Trump and Putin. The euro is barely budged. Why?
I think that euro-dollar over the next couple of years is going to 130 before 104. I really think we're in a massive paradigm shift. I think it's really, really momentous. And I think that dips will really... I think a lot of people are going to wait to structurally go, oh, I need to get in this Euro story. And they're waiting for those dips. And those dips are going to be disappointing. We might get back to 106, 106.50. I really just don't see us getting much further than there. I think the massive structural amount of money to come into euro out of dollar hasn't even started yet.
Am I short European stocks, though, from here in the short term? Because of the fact that that move has been very aggressive and very fast as well. We've seen the US go down very quickly, Europe go up very quickly. Stock story here I'm talking about.
Yeah.
Does that need to kind of rebalance as well a little bit?
I'm actually, despite the fact that I sound a little bit negative about the US worries, I'm actually quite constructive globally. I think this in a world of a weaker dollar, I actually think we get reflation elsewhere. And I think that I'm generally constructive. So to me, it's not about being short somewhere. It's like if you've made some decent gains, it's time to take a bit of profits, take some money off the table to kind of step back to get better re-entry levels. So yes, I think European stocks can suffer in the short term, but I don't think it's a negative story. It's about a consolidation of a really long-term structural story, and they've got a little bit ahead of themselves in that kind of short-term thing. So yeah, we might see Europe be a little bit more at the forefront of the pain in the next couple of weeks. I think we'll get a wash out of some of the consensus trades. Maybe China, Hong Kong pulls back a little bit as well, even as US bounces. So that's maybe the theme for the next couple of weeks. Wash out of what we've seen work for March.
OK, well, let's turn to our stocks to watch now. We've got Joe Easton on standby as we head towards the open. Joe, what are you watching?
Morning, Lizzie. So we're keeping an eye on Kering today as Gucci gets a new creative director, Demna Gvasalia, coming in. He previously had success in the Balenciaga brand under Kering, so he is tasked now with turning around this struggling stock price that we can see on the screen there, down 55% on a two-year basis. He really does have his work cut out. JP Morgan today writing that it is a controversial choice for that pick, and they also see weakness in the sector in general. Then looking at Universal Music, Bill Ackman offloading a load of that stock. He's not really made too much money out of it since he invested back in 2021, but that could weigh on the stock today. Meanwhile, in Italian banking, UniCredit gets approval to increase its stake in Commerzbank to almost 30%. That's from the ECB, so that could potentially be a sector worth watching today. And then in your analyst ratings, a lot to pick from today, but we have got a couple of upgrades in the beer space. Carlsberg is a buy or an outperform, and Heineken at RBC, a holder buy at Goldman, and Puma could be weaker once again as UBS cuts that one to sell. Keep an eye on Puma in Germany today.
Market open's about to happen here in Europe. Keep an eye as well on UK assets. UK GDP this morning, quite weak. We'll open the markets in a minute. This is Bloomberg. Friday the 14th. Good morning, folks. Let's talk about what we're expecting in terms of the day ahead. In order to do that, let's start with yesterday and figure out what happened there. European markets closed, equity markets closed about here. US markets closed over there. I'm not sure there's actually much of a read across because the Schumer news in terms of what's happening in the Senate and the fact that the Democrats backed down in terms of the government shutdown came a little later, Mark. So that's being reflected in futures this morning. But European futures don't look that punchy this morning.
No, they're not too exciting. In fact, they're actually getting less exciting as we speak. When we came to this board only about 10 seconds ago, these are a little bit more impressive moves. We're seeing a 0.1% gain in Eurostoxx 50 futures. Obviously, they've had a tremendous run this year, but it's a bit more difficult week. We're seeing DAX futures 0.1%, that really important vote in Germany next week on the fiscal spending. And of course, FTSE 100, the most exciting of the day in Europe, 0.2%. We had that very weak set of data this morning out of the UK, but sterling slightly weaker. That's helping the stock market there. Lizzie, what are you seeing?
I appreciate you out trying to find some excitement here, but look, let me take you to the individual stock story, because we've got this news that UniCredit's cleared this important regulatory hurdle for its potential takeover of Commerzbank, permission from the ECB to own as much as 29.9% in the German lender, so we keep an eye on UniCredit and Commerzbank. We also watched BMW. They had their results this morning, of course, saying that car-making profits are going to lag well below their long-term targets this year. And then, of course, we've got to watch Kering. We've been talking about their controversial pick for designer, the man who fueled the sales growth over at Balenciaga. Can he turn around Gucci, which, of course, has been struggling? But, Guy, the big question this morning, can European equities turn around this morning after yesterday's tariff threats?
Yeah, we're going to keep an eye on what's happening with some of the drinks producers as well. I think that's going to be a really interesting story to fold into these markets as well. OK, here we go. Friday session is about to start. Let me give you some opening numbers. It's time for the opening trade. This is the picture we are looking at first thing this morning. Remember, as Mark said, we've had some weak data coming out of the UK. The pound has reacted to that. There's a kind of mechanical effect that folds back in, therefore, to the equity market in terms of translated earnings. But this is not an exciting start to the day by any stretch of the imagination at an index level. The stock 600 absolutely flat as a pancake. We are not getting a Friday bounce after a bumpy week, it seems, certainly when it comes to European stocks. The IBEX is down. I don't draw a line between Krithi Gupta being in Spain and the IBEX being down. There is no correlation there whatsoever. But we'll watch for her interview a little bit later on with the Bank of Spain governor. The CAC 40 will wait for that. We'll see what happens with the luxury space. The DAX, I think, is going to be an interesting trade as well this morning. Let me figure out what is going to happen next in terms of this stock story by maybe examining, Lizzie, what's happening at a sector level.
Yeah, so if we break it down by sector, so far you've got just over half of sectors in positive territory, and leading the gains this morning is basic resources. So that's up nearly 0.5%. Food, beverages and tobacco not far behind. That's up 4%. And that's obviously a step back after yesterday's reaction to Trump's tariff threats, 200% on wine and champagne. And actually, if you look on individual names, you've got the likes of LVMH now flat to the upside, but Humi Quantro up 0.4%, Pernod Ricard up 0.7%, so bouncing back a bit after yesterday. But what are you watching, Mark?
I mean, look, as I said, I am just so tense about kind of retail sales on Monday, and that signals that it is the University of Michigan sentiment. I think today it's the price action ahead of that, because that's the next big data point. It's actually not less than the news flow today. It's because that's the price action. This is a market that is trading still quite poorly. I think there wants to be one more washout. And so therefore, what's the close today? Also an important signal. There's a lot of people waiting to buy the dip. We heard from our earlier guest. We might hear from our next guest about whether people want to buy the dip. And I think that close today will be very important going into retail sales FOMC. So price action is key.
This is a market that cannot make up its mind. So in terms of the stock 600, you've got 270 stocks, 276 stocks up and 291 down. Just a moment ago when I looked at the screen, it was kind of 280, 280. Basically, you've got as many stocks up as you've got down right now. It feels like it's a market that wants to sit on its hands. It's a wait-and-see economy, as Torsten Slok talks about. It's a wait-and-see market this morning.
OK, well, let's get some more analysis now with Beata Manthi, who is European Equity Strategy Head over at Citi. Really good to have you with us around the table, Beata. Looking at the way the market is at the moment, I mean, we're waiting for the DAX to open, but I was looking at the DAX, and it's pretty much where it started a month ago. Ollie Crook was telling us about the German vote that's happening on Tuesday. Do you think that if the vote is priced to pass, there's any further to go for German equities?
Not only German equities, but European equities overall. So, of course, right now the market is torn by many contradictory forces. It's always about the balance of risks, positives versus negatives. So I think what is happening internally in Europe via the stimulus, what the new coalition is going to do, the vote that is going to be passed, it's definitely a step in the right direction for Europe overall. And potentially, when everything gets passed, it is a game changer, because until recently, or over the past 15 years in the post-GFC wars, investors have been looking at Europe as just another trade, right? Given its cyclicality, in the words of no rate of no inflation, it was an impossibility for Europe to outperform over longer term of a very growthy market like the US. Now, the stimulus, eventually, it's going to be gradual, but it's going to improve the GDP prospects for Germany, for Europe, and therefore it will improve the EPS prospects over the longer term for the European equities. And that's crucial, right? Okay. So Europe is going to be a longer-term asset allocation proposition, not just a trade.
So we're waiting for when and if that vote passes and you get fiscal injection. We're waiting for when and if we get some tariff certainty. What about the Ukraine story? Why isn't there more optimism in this market reflecting what we're hearing from Putin and Trump?
There's been a lot of volatility in the news flow on that front, right? Eventually, when the ceasefire happens, we think the biggest translation into European equities, especially, is going to be via lower energy prices. So City as the house, our commodity strategies are quite bearish on the outlook for oil. We have $60 oil. We have meaningfully lower natural gas prices. And ceasefire would only exacerbate these moves, right? Putting the forecast from our commodity strategies into the actual consumption for last year, energy consumption in Europe, we could get around 1% savings of 1% of GDP worth of savings via energy costs only. So that could be potentially huge.
Mark thinks we're going to 130 on euro dollar. So what would are you going to see a commensurate rise in stocks with that? Well, is that reflective of? Does stocks lead that, or does the currency lead that? What is the lead indicator in that story?
Actually, to Beata's point, I think we're at a paradigm shift in Europe. And I think you used the phrase, it's not just a trade, it's an asset reallocation story.
Yeah.
And that's a story that plays out over several years. But
in terms of order of magnitude, what are we talking about?
Well, I actually want to ask that. But for the currency side, I think that is about, the point is that we're going to have assets reallocated. Like, the 95th percentile of everyone's allocations went to the US, in January. People are max invest in the US. The whole world's going to be taking money out of that trade and reallocating to elsewhere. Maybe not just Europe, but that's what I'm curious in your view. So, to Guy's question is, what is the scale of a potential move here? If we're talking about a paradigm shift, if we're talking about Europe, what is the scale of upside we can get in European stocks? And is Germany the best player, or is there a better market in Europe to play it?
I think the best player is broader cyclicality in Europe. And cyclicality, like the order of magnitude, is the cyclicality that still has been left behind. So energy-intensive part of manufacturing base, right? That hasn't done as well. And of course, therefore, Germany is the best candidate for that. But what we've been arguing, our preferred trade for German election was to go long MDAX, so mid-cap index over DAX, right? Because this is potentially the part that, well, it's still subdued and could pick up via the stimulus.
Fold tariffs in for me. So what does, if we've got 200% tariffs potentially coming on alcohol sales. If we get an aggressive tariff story coming out of the Trump administration, back out for me from that positive story that you're talking about, what that will detract from the European equity picture.
Tariffs, we've been saying throughout the year, is the biggest risk for European equities. So we have basket that try to capture what kind of tariff risks are priced in by the market. And the basket that we run that is tariff sensitive actually has not moved up at all since December lows. So despite the market moving so high, the most vulnerable part of the market has not bounced, right? Pricing in some tariff risks. But our assumption for tariffs was a broader base 10%, not 25%, right? So if there is a risk of 25 or more, not to mention 200, right? If that materializes, of course, nothing is pricing that in. So that's definitely a risk.
I know you're focused on European equities, but I'm curious about the context of your views. You're saying there's potential paradigm shift in Europe, structural asset reallocation to Europe. But is that within a view of kind of globally positive on stocks? I mean, I'm curious about ignoring maybe the US moment. I know it's going to be key to that story. But do you think much of the rest of the world is also going to gain, or do you think this is specifically a Europe-focused bullish story?
So I do both Europe and global, actually.
Okay.
So I think it's coming from both sides. One side is very positive, surprisingly positive news flow from Europe. Okay. And on the opposite, on the US side, that's something that has already started at the end of last year, is diversifying away from very rich, priced for perfection US market and tech, right? So this is the deep seek effect for now that is playing out in the markets.
So what about
through
China?
This correction?
Like, how much do you weigh into that?
Absolutely. So there are lots of steps that we've spoken about, the ceasefire, lower energy prices. Of course, China coming out with some meaningful stimulus for consumption would be another tailwind, right? China has already done very well, but it's done well only through the tech stocks, right, and internet stocks. The rest hasn't moved. So the rest could move.
Could move, okay.
With the right stimulus.
Is it as simple as just going out there and buying a basket of ex-US stocks, global stocks? So I just go, right, US here, big basket of US stocks. Mark's shaking his head.
No.
You're not convinced. Is it that simple, or do I need to be much more nuanced?
Well, it depends what your remit is. If that's all you can do, by all means, that's what you should do. But I think we've moved on. That was the case, just selling Europe end of last year and starting buying everything Europe towards the end, right?
Why are you... The world's more nuanced now. So, like, there are lots of super cheap stock markets out there, right? And there are lots that are super expensive, not just the US. You take India, for example, a really expensive story. And so it's not just the rest of the world is discounted. Much of the rest of the world is discounted. There are many discounted opportunities, but not the rest of the world. So I don't think you just blanket buy. I think there's actually a chance to pick by sector, by country.
I agree. And coming back to your point on reallocation, we've already started to see a bit of that, right? So the first squeeze on Europe higher was through very bearish positioning. That's no longer bearish. But we've only started to see traditional inflows coming in like 4 weeks ago, and they're only picking up on steam, right? For now, they've been only passive-driven flows that we've been seeing. Actives haven't come in yet, but we are waiting for actives to come in, right, to capitulate and start coming in to Europe, and that would be a very different part of the market being unlocked by these flows, to your point, being more selective and being brave once the dust settles after that correction, to start thinking about parts of the market that perhaps haven't moved as much yet.
Nice to see you. Always
Likewise.
a pleasure. Bielsa.
Thank you.
European global, apparently, as well. Equity strategy at Citi. Thanks very much indeed for coming in. Let's take a quick look at the core six. This is what the centre of gravity in Europe looks like this morning. In terms of what we are watching, you are looking at a fairly mixed picture, which has already been reflecting pretty evenly balanced market this morning. LVMH is a little positive. ASML is actually more positive, up by 1%. But on the flip side, Schneider, which has had a decent run, is a little bit softer. BMW's in focus. I think that's certainly one stock story they're going to be watching. Plus, also, what's happening at Kering? Let's find out with Joe.
So that's where we've got to start, Guy, because Kering absolutely slammed at the open of trading. We're down around 11.5% now for Kering. Now, remember, the new creative director at Gucci, he's an internal appointment, and some people wanted somebody coming from the outside and coming in and giving a fresh voice. He's also been a bit controversial in terms of his role at Balenciaga, so it is a surprise for the market. There was also speculation a few weeks ago that the Miu Miu director, I'm probably completely mispronouncing that, but he was going to come over and save the day for Gucci, and this is not happening. So a real shock for the market today. I've been asking traders in my IBs, as usual, what's going on there, and they just completely think this has caught the market by surprise today. Then another stock getting hit over in Amsterdam, Universal Music plunging. We're down around 10% on that one, 9.5%, as Bill Ackman's Pershing offloads a big stake in that company. He was an investor when the firm was spun out of Vivendi around 4 years ago. He hasn't made a huge gain out of it, but he is coming out. He recently said that the company should actually relist to the US, but at the moment it's the share sale at a discount, getting a bit of a hit on that stock today. Then in terms of BMW, as Guy mentioned earlier, that one a little bit weaker. It looks to be the margins weighing on that one, according to the Bloomberg intelligence piece. Missing expectations on the year-ahead margins for BMW. Weakness in autos once again. Then over in the banking space, news of UniCredit potentially going to be pushing up its stake in Commerzbank to close to 30%. Here's those moves on the screen here. We're seeing Commerzbank gaining around 1%. UniCredit has been the big hunter of the stocks in that space, coming down a little bit at the moment, but an interesting one to keep an eye on, with Commerzbank edging slightly higher today. UniCredit going the other way this morning. Then on your analyst rating changes, ThyssenKrupp is at a massive rally on the German spending news that we've had over the past couple of weeks, and Morgan Stanley thinks that rally has gone too fast. They go underweight on the stock, falling 5%. It was one of the worst performers at the open of trading in Europe today. And finally, it's Friday, so we're all thinking about beer, of course, and Carlsberg does get an outperform rating along with the rival Heineken. It's over at RBC. They reckon the premium beers is where those companies are making money at the moment. So they upgrade both of those stocks, and we are seeing Carlsberg rising around 3% over in Copenhagen this morning.
OK, Joe Easton from our equities team with some of those stocks on the move at the open. As we have had the opening of the European session, we've also got the start of the US pre-market. And I just want to zoom in on some of these movers here. US tech in focus, Nvidia and Apple both in the green. And this is a read across from Taiwan's Honhai earnings this morning, posting a surprise fall after weak Chinese iPhone sales kind of eroded margins here. But the good news is that, which is an Nvidia supplier, forecast a doubling in AI-related revenue this quarter. We've also had the chairman saying that Honhai is likely to expand production in the US with customers there. And so this good news reading into Nvidia and Apple.
Coming up next, we're going to talk about spirit sales. 200% tariffs. That's going to hurt, isn't it? We'll talk about it next. This is Bloomberg.
The president was totally annoyed that the Europeans did this, and so you're going to hear back from someone who emotionally cares about America. He cares about America, and he wants to take care of Americans. And why are Europeans picking on Kentucky bourbon
Secretary
or
Lutnick,
Harley-Davidson motorcycles?
Are you saying this is an emotional response?
It's disrespectful.
Totally annoyed. Not just a little bit, totally annoyed. Howard Lutnick, the Commerce Secretary in the United States, speaking to Bloomberg yesterday, talking about the Trump response to the European response to the Trump tariffs and a focus there on the alcohol industry, which apparently is going to be responded to. Take a look at Remy shares. This was the reaction yesterday you got to those comments that came through. Trump threatens 200% tariffs. European drink stocks go down quite sharply. They bounced a bit this morning, but not by much. And we are still negative on a two-day basis. There you can see the response coming through. He is totally annoyed. Kentucky bourbon shouldn't be an area of attention. Let's talk to Pauline Bastillon, Director for Trade and Economic Affairs at Spirits Europe. It's the main lobby group for the EU spirits sector. Pauline, good morning. What would 200% tariffs on European spirits and champagne sales to the United States mean for your industry?
Look, we're really deeply concerned by what we're hearing. The prospect of tariffs coming back on both sides, equally. I mean, we were very concerned when we heard about the prospect of 50% tariffs on US whiskey, and we're extremely concerned about the prospect of 200% tariffs on our products. I mean, this has to stop because, we're just spun into a wider game. We have no influence over what's happening on steel and aluminium. So, we're just saying to both sides, you have to stop this never-ending tit-for-tat escalation. This is not going to help anybody. We're fully aligned with our US colleagues, on the other side of the Atlantic. The companies that produce bourbon and American whiskey, many of them are actually European companies. You also have American companies producing European spirits in all kinds of regions of Europe. And they support, jobs, rural areas, growth in all these regions. So if we want to continue doing that, we really need these threats to go away and to go away immediately.
Pauline, obviously this is bad news for your industry. I think, no one is surprised by that. But under this current US administration and given the tension in trade at the moment, some bad things are going to happen. Some industries are going to get affected. So what if it doesn't get resolved? What if they don't listen to your pleas? What if these, there are high tariffs imposed and sustained, let's just say, even for a few months, I'm not saying for a longer term, what will be the most immediate impact on your industry?
Look, this would be utterly unacceptable for us. So now Commissioner Šefčovič is going to meet with his counterparts. They're going to have a phone call. We're fully relying on them to sort this out, to take us out of this unrelated dispute. We've been caught in too many unrelated disputes in the past. This one could be really deadly, could be a really deadly blow. We cannot afford it. Our US colleagues cannot afford it. Nobody wants it in our sector. No one wants it in our industry. We've never asked for it. So, for us, it's very clear. We are just asking to be taken out of these disputes. We don't even want to contemplate the prospect of these tariffs coming.
Pauline, I get that you are frustrated that you're caught in the crosshairs here, but I'm wondering what your members are telling you is going to be their strategic response to this. Are they going to absorb the cost and hope that the tariffs go away, or are they going to raise prices and lose market share?
I mean, how can you absorb cost related to 50% tariffs, or even worse, 200% tariffs? This is not possible. So, of course, consumers would feel the pain, ultimately. And that's why, we don't want to go there. We don't even want to contemplate that prospect. We're hoping that both sides will cool down, sit around the negotiating table, find an agreement, because, frankly, that's the only solution. We've all invested too much into this relationship, too much on both sides of the Atlantic to just, let it finish like that. It cannot end in this way. This is just, a prospect that we're... when we consider all the jobs, all the real jobs, the companies, the effect, that this would have on rural communities and so on retailers, on bars, restaurants, who have already suffered enough with COVID. Surely common sense must prevail at some point. So our members will do everything they can, but, at the end of the day, they just want to trade.
Yeah. Pauline Bassidon, we got it loud and clear. Director for Trade and Economic Affairs at Spirits Europe, we thank you. Now, let's turn from tariffs on drinks to tariffs on automakers. And this industry also bringing us results from BMW. The car-making profits expected to lag well below long-term targets this year. This is partly because of the escalating trade tensions threatening US deliveries, but it's also because Chinese sales have continued to slump. And we can get analysis now with Bloomberg Global Autos editor Craig Trudell, who joins us around the table. Craig, I want to start with BMW then. What's hitting them most? Is it the China demand story? Is it the tariff story? Or is that going to happen later down the line?
I think BMW is kind of a rare case within the industry at this point. Most of the forecasts that we've seen, the ranges that we've seen from car makers has been we're going to give analysts and investors a sense of where earnings are going without contemplating tariffs. And I suppose in their defense, you don't have any clue what's going to happen next, given the sort of news flow lately. But for BMW, they made an attempt here to sort of factor in tariffs into their guidance. That is a big part of what's keeping them contained for this year. They do actually expect to see better sales this year than they saw last year. I do think that they are concerned about the sort of state of affairs in China and the broader industry pressures that are being felt. Because, to be clear, it is not just them that are shrinking in China. It's really, the international car makers. Virtually everybody is getting hit there.
Let's talk about Tesla and what's going on. We saw the Trump kind of sales pitch, which was, I think, probably enjoyed by a lot of people. Tesla's under pressure on multiple fronts at the moment, though. The stock price has been absolutely hammered. Is there any light at the end of the tunnel? Is there anything Elon Musk can do? Is he in any way focused on this and trying to solve the problem? How much worse can it get for this company?
I think his comment to Larry Kudlow on Fox Business the other day that he was running his other businesses along with doing his job in Washington with great difficulty. I thought that spoke volumes. I think just overnight we got comments that Tesla's submitted to the U.S. Trade Representative, kind of, in an opportunity for companies to speak about the potential impacts of all of the administration's trade actions. Tesla sort of raising its hand and saying, you know what, we're going to have issues here as well. We're going to see that, I think we've already seen that this year in terms of where Tesla's sales have been trending over here in Europe. And I do think that as we see, these strategic attempts to try and hit American companies, you think of Harley-Davidson motorcycles, Tesla electric vehicles, it is kind of synonymous with American product as well.
Where do Teslas that get sold in Europe get made?
So you have, of course, in Germany, you have, Tesla's made Model Ys, their most important vehicle. The Model 3 comes over from China. So that is, perhaps a limited option for the EU to take a whack at Tesla.
OK, Craig, great stuff. Thank you very much indeed, Craig Trudell. We're going to talk Skoda next. We've got a great interview lined up. That's coming here on Bloomberg. See you in a moment. welcome back. Friday morning. Equities are a little bit bid in Europe this morning. Bond markets on offer. It's going to be interesting to see what happens with the bond market by the end of the day. You've got University of Michigan data coming through. What do you make of what you're seeing thus far? Is this just everybody taking Friday off, or is there something in this?
Well, Europe's being a little bit more optimistic than the Asia session was. The Asia session was super positive around China, but it wasn't feeding through broader. Even Hong Kong was lower beta to the China stocks gain, which you don't normally see because the Hong Kong tech sector was suffering. So I thought that was interesting that Asia was very cynical about the Chinese gains. They were worried about going to the Friday session. You're seeing Europe a tiny bit more positive. And I think if you get maybe another 0.3, 0.4%, you start getting some short-term technical break in the US stock futures. The 10-day trend lines will kind of break. I don't think we actually get there. I think we go back down.
On the 5-day, we're negative. Europe is negative on the week.
Yeah.
But it's not as negative as the States, which I think is significant.
Yes.
One of the sectors that's negative this morning is autos. We've already talked BMW, we've talked Tesla. Let's go to Berlin now. Bloomberg's Oliver Crook is with another cars guest.
Yeah, that's right, Lizzie. Thanks very much. Yes, Skoda is part of the Volkswagen family, and it's also a rare bright spot in a sort of struggling industry here in the auto sector in Europe. It's at full production capacity. They've set a record on deliveries last year, up 7%, and they're now actually the third biggest brand in the EU. Plus, its margins are beating both Mercedes-Benz and BMW, the luxury end of the sort of spectrum here in Europe. It is also critical for the Czech Republic. It's responsible for about 5% of Czech GDP. Accounts for about 10% of the country's exports. And also Czech car production, as partially a consequence of Skoda, is about to surpass France's. And Skoda alone makes more vehicles every year than the nation of Italy. So we're very pleased to be joined by the CEO, Klaus Zellmer. He's also served previously at Porsche and Volkswagen. I think we need to begin today on the question of tariffs. Obviously, you're a brand that is very focused on your sales here in Europe, so you're less affected by this. But I'd like to understand the second-order consequences of what we're seeing out of the United States on Skoda.
Yeah, thanks for having me, Oliver. Of course, there are indirect effects. Since we do not sell in the United States or North America, and we're basically putting our future on India and the ASEAN region, we're not directly affected by the current tariff discussion. Indirectly, yes, because all our suppliers, they're globally based in many areas of this world, many regions. And of course, the cost pressure that is increasing then also affects our margins. And there's another effect. If China can't sell anything in America, they will look for other avenues to pursue their growth ambitions with, and of course that's Europe. So our pressure in Europe, fighting for customers, especially with battery electric vehicle transformation, is increasing.
I mean, also, this sort of one of the issues that, or I should say, one of the advantages that Skoda has is really has on the cost advantage, right? Which is you have had lower labor costs, you have input costs that are very reasonable, and at a time when the rest of the industry is really struggling, I'm thinking of Volkswagen that's been cutting costs and cutting some of the bloat out of the system. I see that, and then I wonder, should there be more production from Skoda? Your assembly lines are currently full. Is that something you're looking forward into the future as sort of how much it will contribute to Volkswagen's core output?
Yeah, I mean, we're very proud, and this has been the case for years and years and years, that we are running a very lean system, very highly efficient on cost at Skoda. This is one of our traditions. We're 130 years old, so we must have done something right to be that long in this game. And I call it the factor cost. The factor cost is, of course, wages, is electricity, is everything you need to invest into then producing cars. And they're more favorable in the Czech Republic than, for example, in Germany. Our capacity is fully utilized at the moment, so we can't offer any advantages here. But where we can offer advantages, we also have our research and development engineers and departments. And this is where we, of course, take over more responsibility from Volkswagen, especially, for example, for combustion engines, where we have a powerhouse in our engineering department. And going forward, it could also be the whole platform that in future then hosts hybrid systems, as an example.
And you've also put out a car now that you're aiming for, and you're having basically cost parity for an EV and a combustion engine car. The margin parity is not there yet, but given your sort of structural cost advantages, do you think you could be the first within the VW family to reach margin parity, and how far away is that?
We're not there yet. I'm being very honest here. And you said cost parity. Unfortunately, it's price parity.
Sorry, price parity is what I meant. Yeah.
But it doesn't matter. It's fine. So we're making lower margins on the battery electric vehicles. However, we have an obligation to fight climate change, and with our battery electric vehicle lineup, with the L-Rock that is as expensive for consumers now as its sibling, the Car-Rock. This is the first step we're going to pursue with exactly that strategy with all our battery electric vehicles, but it is a fight and it's not easy.
And I'd like to also get your idea, because obviously you're doing very well in Europe, but you're very indexed towards Europe. You're very reliant on Europe. In terms of thinking about expanding the Skoda brand, where you'd like to, you're pulling out of China, where it's a very small market for you. Where are you hoping to grow, and sort of what sort of measures are you going to be taking in terms of potentially, factories and putting plants places? What is your plan there?
Yeah. Our footprint, and you're absolutely right, we need to balance out Europe with something else. Something else for us is the ASEAN, so especially India region. India as a market has got the biggest growth potential going forward of any of the, in that category of size of markets in the world. We have already 2 factories there. One factory where we produce Skodas and VWs, and we have 1 CKD factory, so kits of cars being assembled that come over from other places of this world. And currently, yes, we're putting a lot of focus on India, because this is where we want to create that second leg, the second leg to have a solid stand, not just one leg on Europe.
And so the idea would be to then export from India. Is this the idea, to build out the base there? So if I were to ask you where the next Skoda plant is going to be, where is that?
There's no plan to build another one outside India, except that we have just started one in Vietnam.
Okay.
With a partner. This is a CKD factory. And you're absolutely right. One is India as a market, domestically, high growth potential. This is what we want to exploit. The second one is then export potential from India into the so-called ASEAN markets. And, by the way, also Middle East.
And then another sort of theme that we've been talking a lot about is there's been, as the sort of auto industry has been struggling, there's been a huge amount of money, huge amount of interest going into the defense sector. The Czech Republic is benefiting in part from that. I'd like to get an idea from you what you imagine the consequence of that will be on your industry, because now potentially you're going to be competing much more for headcount and the sort of very low labor costs that you enjoy in the Czech Republic. Are you going to feel upward pressure on that, and how are you managing that?
We certainly are going to feel, because in the Czech Republic there's basically no unemployment. So, the workforce is fully utilized. So if new players come in that are looking for workforce, the wage is the price. So those prices might go up. You're absolutely right. Now, we have a workforce that is very loyal to the brand. And actually we're paying above average. So we're not scared, but we are aware that something like that might come.
I'd like to talk to you also about the emission regulations that are sort of being debated right now in Europe. And I understand your expectation is that they're going to extend that over a 3-year period rather than the one. How important is that to Skoda? And even with that, do you think that the EU is pursuing the correct approach here?
Oh, totally. It is the right direction. Now, the CO2 penalties would kick in by the end of this year if you don't meet a certain average CO2 output of your cars. And we have done our homework as manufacturers. We have a portfolio of cars in the place, and I'm not just talking Skoda, I'm talking about the automotive industry. And this is a threat for the whole industry. Because in the second half of the year, in order to meet that deadline, and it is a deadline, everybody's going to try to get through that gate. And that's going to cause a lot of disturbances in the market, because consumer sentiment, for various reasons, for cost reasons, charging infrastructure, electricity prices, is not there to get to the share of battery electric vehicles we need to get to in order to be CO2 compliant. And that's why the 3-year window that is being discussed currently, maybe 4, maybe 5, will really help us.
And really one of the most sort of important goals right now for the European Commission, if we believe what they say, is basically making Europe more competitive, particularly against a United States that is massively deregulating, that is really boosting its own economy. From your perspective for the auto industry, what do you think the EU could do that would be most helpful to boosting the automotive industry within Europe?
Yeah, we need deregulation, we need less bureaucracy, we need a system that we can rely on. To give you an example, incentives in order to boost battery electric vehicles says if they ever create something pan-European, which is my request, we have to have that sustainably embedded in our ecosystem. if you turn it off, and this happened in Germany as an example, in the former administration, it basically shocked the market so much that we're actually the weakest battery electric vehicle transformation country here in Germany, in Europe at this point of time in terms of speed of transformation. So you're shocking the system. You mustn't do that.
All right, well, Klaus Zellmer, thank you so much for your time today. Greatly appreciate it. That was the Chief Executive Officer of Skoda there, talking about everything from the Chinese competition to U.S. tariffs and, of course, those key CO2 regulations kicking in here from the EU guy.
Ollie, great stuff. Thank you very much indeed. There's been much debate around the table this morning as well about the jacket. I'm a brown jacket, huge fan. Very cool. Not everybody entirely agrees with me around the table. Lizzy in particular.
Outing me like that.
Sorry.
It could have been Mark. Moving on, though. Coming up, we're going to stay
You're assuming I noticed.
As the country's parliament heads to a crucial vote on spending next week, we're going to dig into that story with Monica Schnitzer, who is chair, of course, of the German Council of Economic Experts. This is Bloomberg.
Well, generally speaking, European countries need more of everything and of a better performance. That's a general answer. And now, looking at what is happening in Ukraine, there are some probably more urgent matters like electronic warfare. This is a topic that is mentioned, I would say, regularly. Air defense as well. It shows that you need to protect your airspace, and it's very visible in Ukraine. And of course, ammunition.
CEO of the French defence company Thales talking to Bloomberg, talking about what happens next and what Europe has got to deliver. One of the biggest factors in this debate is what is happening in Germany. The German Conservative leader, Friedrich Merz, the incoming Chancellor, we think, says he is, quote, very optimistic that the country's debt spending package will be approved after a parliamentary debate today. The vote is Tuesday. Merz said the SPD presented an ambitious fiscal package last week focused on ramping up defence spending dramatically and creating an infrastructure fund that would skirt Germany's defence debt brake. Freudian slip. Let's talk to Monica Schnitzer, chair of the German Council of Economic Experts. Monica, how confident are you that this package that is proposed by Friedrich Merz is going to see the light of day, is going to become a reality?
Put it like this, it's really necessary that this package will pass the parliamentary vote, and therefore, let's also say I'm confident that the parties will work on it to convince, in particular, the Green Party to vote for it, but there could be some stronger efforts. Let's call it a charm offensive. I think that would be really needed because for the last months they have treated the Green Party very badly, and also there are some elements in this proposal that are not convincing, and hence there is more discussion needed.
What is we've just been discussing this around the table and trying to understand what is happening here. What happens if it doesn't go through on Tuesday? What happens next?
Yeah, then we are really in trouble. I mean, first of all, it would be so important to pass this law, this new law, because it really would send a signal to Trump and to Putin that Germany is stepping up on its defense spending and has the means to do so. So if it doesn't pass, then in the next parliament, so the newly elected parliament, it would be rather hard to get a two-thirds majority that would be needed for constitutional change. Because the right-wing populists, they definitely don't support it because they are for Putin, if you may. And the left-wing party is also not happy about spending money on defense. So that would be really difficult.
Mark, has the market got that?
No. Monica's panicking me here. Monica, you don't sound like you're sharing Merz's very optimistic kind of expectations for next week. And I'm curious, I mean, what probability would you put that 6 months from now we haven't changed or dramatically changed the kind of fiscal approach in Germany. Is that like, I mean, I think the market is assuming that the chances that, we're not going to ultimately get success here is probably only a less than 10% tail risk. It sounds like from you think there's a material risk that we fail next week and there's not really a backup plan. So I'm just kind of curious, what kind of probabilities would you ascribe to success versus failure here?
I don't want to move the market with my probabilities. So I'm still an optimist, and I think Merz will understand that he really needs to approach the Green Party. He has done so already by offering them to include climate policies into the infrastructure package that's supposed to come along. The really crucial thing at this point is to make sure that the new investment is going to be additional to what investment we have been doing so far. That's the crucial thing, this additionality that so far they have not committed to. And the real worry that the Green Party has, and that is very understandable, is that this new package will be now used to leave room for all kinds of nice little presents to clients, people, so to people that now like to get a little tax break here, a little subsidy there. And in order to prevent that this is going to happen, the Greens are demanding, and not just the Greens, everybody actually is demanding that they commit to an additionality clause to say that what we now make available as new money, as new debt, that this is really going to be spent on additional investment, additional defense spending.
Monica, that clarity around it must be, explicit fiscal expansion. I understand that. And I know you don't want to move markets by ascribing very clear probabilities, but I guess at least help us provide a framework of how to approach the next week. So if we pass on Tuesday and it's all wonderful, that's all clear. If we fail on Tuesday, what's the timeline, the next catalyst after that? What should traders be looking for as the next thing to move the needle on this? How does it progress from there?
So let me say, I am confident that they will, over the weekend, talk to each other and that this will pass. But if it didn't, and this is actually what they need to realize over this weekend when they discuss these things, if it didn't, then it would take a substantial amount of time to actually get a new go on this whole issue, because then the new parliament would have to be started, and then new negotiations would have to be started again with the Green Party, but they would not be enough now to have a 2/3 majority. So they would also need to speak to the left party, and there would be a lot more convincing to be done. So the task would definitely not be easier.
Okay, so Monica, Lizzy here. Let's say it passes then. And I get that you want this to be new money, additional spending. How is the best way to use that money to actually get growth in Germany?
So if it's investment, then this is the best way of actually boosting growth, because as economists, we talk about multipliers. So the money you spend, how much growth will that produce? And the multiplier, this mechanism to actually generate growth is biggest with investment. Defense, the multiplier is smaller because, people can't use the defense equipment to actually live on it, and then this is not going to boost further consumption. So in any case, it's really important to use the money for the infrastructure to really boost investment, to use the money for defense wisely, so to really accomplish what we want to accomplish with it, which is defense to national security. So here the priority should be on national security. The other thing one has to have in mind is, even if the package now passes, the most important mechanism to boost growth is that it provides confidence, because the actual spending will only occur slowly. You need to agree on what to spend, you need to start, you need to plan, you need to order stuff, and that takes time. So in this year, not much of the money will actually be then flowing into orders and will actually be spent. But the real boost will come from confidence, because what we saw in the last year report, what we reported on that is the growth was very much held back by companies lacking confidence, by seeing so much insecurity, and this is what was holding them back, and it was what was holding consumers back.
Okay. Monika Schnitzer, chair of the German Council of Economic Experts, as we look ahead to that crucial vote on Tuesday. Now, sticking with defence spending, the ECB is balancing that fiscal spend story with the US tariff threat. And we've got Kriti Gupta on the ground at the Bank of Spain, a member, of course, of the Big Four and the Governing Council. And Kriti, I'm wondering, as you approach your conversation later with the Bank of Spain governor, how the ECB should be thinking about that balance, because, of course, that is at the heart of the April debate, the April decision. Do they cut again?
This is the catch-22 that you are seeing in markets and, of course, behind closed doors of the ECB. Because on the one hand, the fiscal spend, in theory, coming out of not just Germany, but the likes of Spain, Italy, France as well, is indeed inflationary. And that should be a good thing. You're seeing that reflected in the markets as well, specifically in the German yields. The problem here is just how quickly that spend can actually come to fruition. Even if you do actually get this vote passed from the German government, whether or not at the end of the day that has ripple effects into the economy as quickly as perhaps the ECB and the governors of, or in the, actually the presidents of these countries actually want. On the other hand of this is, of course, the U.S. tariff story. We've already seen countermeasures in play. Now, we are waiting till that very last minute to see if those negotiation tactics can indeed play out. But at the end of the day, on the one hand, you have real pain in growth. On the other hand, you have a real uptick in inflation. And that's why there is kind of some cold water being thrown on this idea of going back to ultimately neutral, and maybe even going back to this idea of continuous cuts instead of potentially pausing in April, as you mentioned, Lizzie. There's another piece of this as well, which is where does the defense spend actually come from? Because at the end of the day, you need European banks to be able to remove some of the red tape around being able to provide lending to some of these countries and companies that are looking to create more in the defense space. And right now, there's so much red tape there that a lot of that spend ultimately is being leaked back to the United States. That's what the ECB, from a regulatory and a monetary perspective, have to tackle.
Kriti, looking forward to the interview, looking forward to watching it, looking forward to you being back in the chair on Monday and talking us through what you've learned. Kriti Gupta at the Bank of Spain. So we're nearly done. What a week it has been. I think we all deserve a weekend. I think that probably is what is coming next. Jack Draper's playing, I think, in the quarterfinals at Indian Wells, but the weekend is all about but one sport. And that is, I think so England have got to beat Wales with a bonus point, and then I think the Scots have got to beat the French for England to win the Six Nations. Ireland?
I'm sorry, Guy. France are going to win it. I mean,
they probably are. I will admit. But Ireland, the Grand Slam was on.
I know. Look, do you know this would have been the first time ever since the Six Nations started that the same nation has won the Six Nations 3 years in a row? It's actually been such variety. Obviously, we haven't had Six Nations for just over 20 years, I think, since Italy came in. But I came here to celebrate the Grand Slam, and then last Saturday got ruined. I've got a day booked in a pub to watch rugby tomorrow, and then I fly out tomorrow night, meant to be mid-celebrations, but instead I'll be drowning my sorrows.
What about St Patrick's?
Well, that's why I'm flying back in time.
It's Monday.
So I get back. I'm actually missing the parade in Singapore. They do a mini parade in Singapore, but it's on the Sunday, so I'm arriving back too late for that. But I will be there to celebrate it on Monday, definitely.
Have you been doing this split in the G thing? It's that TikTok challenge with the Guinness,
I only heard about it this week. Like, apparently...
That's just like the sort of natural thing for Mark to do anyway. He's been doing it for years, probably.
He goes past the G.
No. But, I mean, what a great marketing campaign. I only heard about it this week. It hadn't quite hit Asia yet, but I'll bring it back next week.
I'm sure you'll introduce that cultural phenomenon. Yeah. As I say, tennis is going to be good. I think there's Formula 1 this weekend as well. A lot going on. Yeah. We all deserve a rest. Sit in front of the telly.
I'm not sure it's going to be restful, and then we go straight back into retail sales and FOMC next week. Busy one again. It's fun in these markets. I love it.
It is. It's interesting. We're in the volatility business, and there's certainly plenty of that. That is it for the opening trade. Have a great weekend, folks. The brief is coming up next. Mark, thank you very much indeed. Mark back in Singapore safely next week. This is Bloomberg.